Hi everyone. So in this lecture, we're going to start with financial instruments, which is covered by three standards: IFRS 9, IFRS 7, and IAS 32. The corresponding standards that we have are Ind AS 109, 107, and 32. Now they're actually split into these three standards because of the volume of it. All right. So just to give you a perspective, IFRS 7 is all about disclosures. So all your annual accounts, which runs into about 100 pages, is mainly comprising of IFRS 7, which is all the disclosures about credit risk, market risk, liquidity risk, and so on and so forth. IAS 32 introduces certain terms like what is financial asset, what is financial liability, what is equity, and so on. And the core measurement and recognition is given in the IFRS 9 accounting standard. Therefore, more often than not, given that IFRS 9 actually has the core measurement and recognition principles, we correlate financial instrument to be with IFRS 9 rather than IFRS 7 and IAS 32. The same obviously goes with Ind AS 109, 107, and Ind AS 32. There are few differences between Ind AS and IFRS, which we will discuss at a later point in time. There are three terms that I would like to introduce before we get into the definition of financial instruments. One is financial asset, two, financial liability, and three, equity. All right. Now, although I'm not going into all the definitions of financial asset, for example, I've only covered three sections of financial asset. There are two other sections in the definition of financial asset, which I will cover at a later point in time. So what is a financial asset? Number one, cash is always considered to be a financial asset. Two, any contractual right to receive cash is also regarded as a financial asset. Now, of course, when I'm saying it's a contract, then what we're trying to refer to is that it's supposed to be an agreement which is enforceable by law. And by virtue of that agreement, I need to have a right to actually receive cash. Simple examples would be debtor. I have sold goods to you and we have entered into an agreement whereby I have the right to receive cash from you. So therefore, debtor will actually be treated as a financial asset. Similarly, any investment in bonds or any loan that I've given, it actually is giving me a contractual right to actually receive cash from you. All right. If I've given a loan to you, I have got a right to receive cash in the form of principal and interest from you. And therefore, I will be classifying loans given or investment in bonds as financial asset. Again, bills receivable is almost the same as debtors, and we will classify bills receivable also as financial asset. Now, the third section of financial asset is investments in equity of other entities. All right. So if I have invested in equity shares of Reliance or Infosys, I will treat that investment also as financial asset. All right. And remember, this is not investment in equity instruments of my own company. It's investment in equity of other entities. All right. If I buy my own equity shares, then that's technically a buyback. I would not call it as of investment or a financial asset. All right. Where I've invested in equity shares of another entity, I would then classify that as a financial asset. Like I mentioned at the beginning, there are two more portions of financial asset definition, which I've not covered right now. It more pertains to derivatives, which I will discuss at the appropriate moment. The second term is financial liability. A financial liability is an obligation. It's a contractual obligation to deliver cash or any other financial asset. All right. So in this case, you and I have entered into a contract where I do not have a right, but I have an obligation to pay money to you. All right. Let us think of certain examples. Let us say I have borrowed money from you. All right. I have an obligation to pay cash to you by virtue of principal and by virtue of repayment of principal and payment of interest. This contractual obligation to deliver cash, or not only cash, any other financial asset. For example, if I have an obligation to pay you in the form of investment in shares, all right, like let us say I have Reliance equity shares and I have an obligation to deliver those Reliance equity shares, that will also be regarded as financial liabilities. Few more examples. Let us say creditors. You have sold goods to me. I have purchased goods from you and you have sold goods to me. I have an obligation to pay money to you, and that will also be treated as a financial liability. Any debentures that I've actually issued is again the same as borrowings, and that will also be regarded as financial liability. The third term is equity. All right. Although this is not the technical definition of equity, which is given under IAS 32, but equity typically is represented by a residual interest in the entity. All right. What do we mean by residual interest? Point number one, what we are saying is, In case of equity, I do not have any obligation to pay cash. All right. Let us say I, as a company, have issued equity shares in the market. I do not have an obligation to pay dividend. All right. I will, if and when I declare dividends, only then I'm actually obligated to, but I am actually otherwise not obligated to pay any amount of money to the equity shareholders on every year. All right. So I do not have any contractual obligation. And point number two is the equity shareholders will typically receive the money only at the time of liquidation. All right. I will liquidate all my assets, settle all my liabilities, and whatever is the residual number, whatever is the balancing amount, will be distributed among the equity shareholders. All right. So that is called as residual interest in an entity. The equity shareholders are going to have an interest in whatever is left after paying all the liabilities, and that is what we refer to as residual interest in an entity. The term equity is further defined under IAS 32, which again I will come back to at a later point in time. All right, so these are the three terms that we have actually that I've actually introduced before I'm getting into the definition of financial instruments. Now, the actual definition of financial instruments is that financial instruments are contracts which give rise to financial assets to one party, and they give rise to financial liabilities or equity to another entity. All right, so these are basically contracts where out of the contract, there's going to be one financial asset and the other leg is going to be either financial liability or equity. What is financial asset for me will either be financial liability or equity for you. Example, debtor. All right. Let us say in my books of accounts, I have a debtor. That is a financial asset. In your books of accounts, you will be showing a payable to me, which is actually a financial liability in your books. All right. So we are saying that financial instruments gives rise to financial asset for one party. It is giving rise to financial asset in the form of debtor for me, and it is giving rise to a financial liability to you in the form of creditor. Let us say I have invested in bonds which are issued by you. You are, as an entity, have issued bonds to me. I have invested in those bonds. All right. Investment in bonds is nothing but a contractual right to receive cash. So I will be classifying it as financial asset. For you, you will be showing the debentures issued or the bonds issued as a financial liability because you have got a contractual obligation to pay cash. All right. I have invested some amount with you. At a future point in time, you have an obligation to pay cash for me. So what is financial asset for me is a financial liability for you. All right. Let us say I've invested in equity shares of your entity. All right. I have invested in equity shares of your entity. So investment in equity, like we mentioned earlier, is a financial asset. All right. And it is equity issued for you. It's not a financial liability, but is equity for you. Therefore, what we've actually said in the definition is it gives rise to financial asset for one party. And for you, it can either be a financial liability or it can be equity as well. All right. So financial assets in my books will be either financial liabilities in your books or equity in your books. Now, thinking of it, the accounting that is done by me on the asset side will almost be a mirror accounting that you are going to do on the liabilities side. All right. It is not always true, but just to get a flavor of it, you can think of as whatever I am accounting for on the asset side, you are typically going to account for it from a liabilities perspective. For example, on the investment in debentures, if I am recording interest income, you are typically recording interest expense on it. All right. What I am showing as an asset, you are showing as a liability. What I am showing as an income, you are showing as an expense. All right. This is only to get a feeler. I'm not saying that this holds good in 100% of the times for reasons that we will come to at a later point in time. All right. So financial instruments are basically those contracts where for me, it is a financial asset, and for the other party, it's either a financial liability or equity. Now, let us go into some further examples. Is fixed assets or inventory, is it a financial asset? The answer is no, because by virtue of fixed assets or inventory, I do not have any contractual right to receive cash. All right. Using fixed assets and inventory, yes, I will get some benefit in future because when I sell the inventory, I'm going to get some cash. But that I cannot say is a contractual right. I do not have any contractual right with the stock that I'm holding in the warehouse to receive money, right? Only when I sell the inventory, then it will turn into a financial asset in the form of debtor. But inventory by itself or fixed assets by itself do not give me any contractual right to receive cash, and therefore it is not a financial asset. What about prepaid expenses? Let us say I've paid rent in advance. All right, prepaid rent. I do not have a contractual right to receive cash, but I have a contractual right to receive services. All right. In all prepaid expenses, we have got a contractual right, but that contractual right is not to receive cash, but it's to receive services. And again, therefore, it will not be regarded as a financial asset. Let us talk about tax refund receivable. I paid more amount of tax to the income tax authorities. I have some refund receivable. All right. This is not a contractual right. It is a statutory right. All right. Me and the income tax authorities have not entered into a contract, but it is a more a statutory requirement because I'm carrying out business in the land of this law. Then I am required to actually pay tax to the authorities, and I have a right to receive excess tax paid back from the authorities. It is not a contractual right, but it is a statutory right, and therefore any tax refund receivable is again not a financial asset. Let us say customer advances. All right, you want to purchase goods from people. Let us say I'm selling you a laptop, and you what I'm telling you is you have to pay me a booking amount of 10,000 rupees or $10,000 today, and I will actually deliver the laptop to you, let's say 20 days later. All right, so the amount that you have paid me, I will be showing it as an advance. I will be showing it as a liability, and only when the sale happens I will recognize it as revenue. All right, until then I will be showing it as customer advance, or what is called as deferred revenue. All right, now this liability is a contractual obligation for me to deliver goods. All right, I do not have a contractual obligation to pay cash to you. I have a contractual obligation to deliver goods to you, and therefore it's again not a financial liability. All right, and technically if you think of it, what is prepaid expenses for one party kind of becomes a customer advance for the other party. All right, if I have prepaid something to you, for you it is a customer advance. All right, you will recognize it as a liability, I'm recognizing it as an asset. Both of them are not financial assets or financial liabilities, because I have a right to receive services, you have an obligation to deliver goods or services. Similarly, tax liability, just like how tax refund receivable is not a financial asset, tax liability is also not a financial liability, because it's a statutory obligation rather than contractual obligation. Let us say the same example of laptop. I have sold a laptop to you in the current year, and I am giving you a warranty of 3 years. All right. Some companies might create something called as provision for warranty. All right, because I've sold the laptop to you in the current year, and the warranty is going to happen in the future. To uphold the principle of matching concept, some entities may recognize provision for warranties in the current year itself. All right, this provision for warranties is basically an expense to the P&L account, and it is shown as a liability. It's shown as provisions under the liability side, because I will incur the money in future. This again is not a financial liability, because it's an obligation for me to provide services to you. I will be providing warranty services to you, or any repairs and damages that I will actually make good for you in future. Therefore, it's not an obligation to pay cash, but it's an obligation to deliver services, and therefore again not a financial liability. If you have already done, if you have a fair idea about consolidation already, then you would have a typical understanding of this. Otherwise, you can probably skip the last example, minority interest or non-controlling interest that we show in a consolidated balance sheet. All right, what does that typically represent? It basically represents a subsidiary's share in net assets, which is not owned by the parent. All right, let us say the parent is P Limited, subsidiary is S Limited. All right, when the parent prepares its consolidated financial statements, although say it is holding 80%, it will bring in all the 100% of the assets and 100% of the liabilities of the subsidiary. All right, I am owning only 80% of the subsidiary, but I'm incorporating 100% of the assets and 100% of the liabilities. All right, what I will do is the 20% which is not owned by me, I will typically show it as a part of equity, not actually as a liability. I will typically show it after the liabilities get over in equity section as a non-controlling interest, and I do not have any obligation. The parent entity has got no obligation to deliver cash to that non-controlling interest, and therefore it is not a financial liability again. The last example, if you have not done consolidation, maybe you might not be able to appreciate it, but that's fine. It's not really a significant example that you need to take care of. These are certain examples that we have actually covered. Now let's talk about the most spoken of thing on account of transition to IFRS or Ind AS with regards to preference shares. All right. Now the question that we are dealing is more from an issuing entity point of view. All right. I am the entity which is actually issuing preference shares. I'm raising money through issue of preference shares. All right, how will I classify it? Will I classify it as financial liability or will I classify it as equity? All right, now just to go back, under the Indian GAAP scenario, under the accounting standards, we used to classify preference share capital along with equity share capital as part of the equity section. All right, we have never shown preference share capital as liabilities. I'm just clarifying, under the Indian GAAP, under the accounting standards that you would have typically studied, we have always shown preference share capital and equity share capital together. All right, so that is more from the Indian GAAP point of view. Now let's look at it from an IFRS or Ind AS point of view. Before we actually look into the IFRS and Ind AS treatment, preference shares, a quick recap, they are classifiable into two: redeemable and irredeemable. Redeemable preference shares are those preference shares where the entity has basically issued saying that this will mature on a particular date. All right, redeemable preference shares are those preference shares which have a fixed maturity. All right, the entity is going to repay the money back after a point in time. All right, let's say I've raised money today. Let's say 5 years later, when the redemption date approaches, I will have to pay the money back. That is called as redeemable preference shares. Irredeemable preference shares are those preference shares which do not have any fixed maturity. All right, they are typically like equity shares, because just like how in equity shares there is no maturity date, in irredeemable preference shares also there is no maturity date. And if and when the company, obviously just like how equity shares there is a buyback option, even in case of irredeemable preference shares the company may have an option to redeem it. But typically under irredeemable preference shares, what we are saying is there is no fixed maturity date and only the preference shareholders are repaid at the time of liquidation of the company. All right, and of course there can be a buyback event that can happen in between, just like similar to equity shares. Now another way to classify preference shares is in terms of dividend. There is something called as cumulative and there's something called as non-cumulative preference dividend. What does cumulative preference dividend mean? Cumulative preference shares are those preference shares where entity is basically mandated to pay dividend to the preference shareholders. All right, if the entity has got enough profits in the current year, the entity is mandated to pay dividend to the preference shares. If the entity does not have profit in the current year, then the entity is required to pay current year's dividend in the next year. All right, so the entity cannot escape the payment of dividend, but the current year's dividend is going to just get deferred in absence of profits in the current year. That is called as cumulative. All right, I'm just repeating, under cumulative the entity is mandated to pay dividend to the preference shareholders. So if it has profits, well and good, it is mandatory for them to pay dividend. If it does not have profits, then they will get cumulated. All right, that is the reason why it's called as cumulative. They will get cumulated to the next year, and in the next year you have to pay dividend for the current year as well as the dividend for the next year. Non-cumulative preference shares are those preference shares where dividend payment is not mandatory. All right, if in the current year the entity has got losses, then the entity is not obligated to pay any dividend and is not going to get cumulated to the next year either. All right, so in terms of dividend payments, it can be classified as cumulative and non-cumulative. In terms of redemption or maturity, it can be classified as redeemable or irredeemable. Now in an Indian context, again, as per the Companies Act 2013, companies can issue only redeemable preference shares. All right, companies can issue only redeemable preference shares. Irredeemable is not possible to be issued as per the Companies Act 2013. So now the question, at least maybe some Indian people that I have seen frequently ask is, why the heck are we even studying irredeemable preference shares accounting when as per the Indian law, irredeemable cannot be issued at all? Please don't forget that Ind AS is prepared more from a global perspective. All right, you in India might not have irredeemable preference shares, but you may actually have a subsidiary in, let's say, United Kingdom. And what if United Kingdom actually permits irredeemable preference shares, and you, for the purpose of consolidation, you as an Indian entity will have to consolidate the UK subsidiary, and that UK subsidiary may have irredeemable preference shares, and therefore the accounting and recognition becomes relevant for you in Indian context as well. All right, so although from a local reporting perspective you will never actually have irredeemable preference shares, you may have a subsidiary outside India which may actually have irredeemable, which you will also have to take into account while you're actually preparing your consolidated financial statements. All right, so now that you have the background for these preference shares classification, let us say, let me put a question to you. Let us say an entity has issued preference shares which are redeemable and which have cumulative dividend. All right. So one is, I said they are redeemable in nature. The second I am saying is they have cumulative dividend. The question is, are we going to classify it as a financial liability, or are we going to classify it as as an equity? All right. Recall the definition of financial liability. It says any contractual obligation to deliver cash is going to be treated as a financial liability. If you clearly look at it, I have a contractual obligation to repay the initial face value, or what we call as the redemption value. I have an obligation to deliver the cash on that maturity date. Similarly, I have an obligation to pay dividend as well, because I cannot escape paying the dividend. If I do not pay dividend in the current year, I have to pay it in the next year. All right. So I have a contractual obligation to pay both the redemption value or the face value. Redemption value and face value I'm going to use in synonymously. I have an obligation to pay the redemption value and also the dividend. Therefore, it clearly fits into the definition of a financial liability. All right. And this is the sea change that we are actually talking about. All right. Maybe not many entities might actually issue preference shares, but this is the logic change that that everybody is actually talking about on implementation of Ind AS, because something that was actually earlier classified as part of shareholders fund, something that was classified as part of equity, is all of a sudden being classified as a liability when you transition to Ind AS. All right, it's being treated as a financial liability given that you have a contractual obligation to deliver cash, both in terms of your redemption value and also in terms of your dividend payments. All right. So redeemable and cumulative preference shares are going to be treated as financial liability and not as equity anymore under Ind AS or IFRS. Next is, let us say you've got irredeemable preference shares and non-cumulative preference shares. Under irredeemable and non-cumulative preference shares, clearly the entity does not have any obligation to deliver cash, neither for its redemption value nor for its dividend, because it is non-cumulative in nature. Because you do not have any obligation to deliver cash, we are actually going to treat it as part of equity. All right. So now preference shares can be either a financial liability or an equity component based on the nature of preference shares. Redeemable and cumulative, they are going to be a liability. Irredeemable and non-cumulative, they're going to be treated as equity. Remember, I should have mentioned this right at the beginning. The term equity over here, please do not think of it as equity share capital. The term equity refers to shareholders funds. All right, we're talking about the entire shareholders funds. Do not think the term equity as only equity share capital. So when I'm saying that preference shares will be treated as equity, what I mean to say is they will be disclosed as part of shareholders funds. All right. The next thing is, let us create a scenario where if the option to redeem is existing with the holder. All right. So typically, there can be something called as puttable equity shares, where you are holding the equity shares of my entity. I have issued equity shares, you are holding them, but you have a put option on those equity shares. Let's say puttable equity shares or redeemable preference shares, where the redemption option is with you. All right. If you want, you can always redeem the preference shares from me. So thinking of it from my perspective, because like I mentioned, the whole scenario over here, we are thinking from the issuer's point of view. From the issuer's point of view, I have an obligation to deliver cash. All right. You may or you may not exercise the option in future. All right. But if you do exercise the option, I have got an obligation to deliver cash. I cannot deny making the payment of cash to you. And therefore, even if the option exists, all right, let us say it is not redeemable on a fixed date, but it is redeemable at your option, you being the holder. It is also, in that case also, it is going to be classified as a financial liability, because I as an entity, I have an obligation to deliver cash to you. Now, although it's not there on the slides, what if the option is existing with me? All right. Let us say they are redeemable at my discretion. All right. If it is redeemable at my discretion, I cannot say that I've got an obligation, because at this point in time, the option is existing with me. All right. So I will obviously not say that I have got an obligation to deliver cash. And therefore, in that case, if the option is existing with the entity or with the issuer itself, it's going to be treated as a it's going to be treated as part of equity and not as financial liability. If the issuer has got the option, then it is not a financial liability, because I do not have the obligation. But if you as the holder have got the option, then it is an obligation for the issuing entity and it will be treated as a financial liability. Now you might get some thoughts in your head of different other combinations. What if it is redeemable plus non-cumulative? Earlier I covered redeemable plus cumulative, and I covered irredeemable plus non-cumulative, right? Now you can mix up the other scenarios like redeemable and non-cumulative, or irredeemable and cumulative. These are called as compound financial instruments because one part is having a contractual obligation. Redeemable part is having a contractual obligation. Non-cumulative part does not have the contractual obligation. So that is the reason it is called as compound financial instrument. Compound basically refers to, it has got two elements. It has got the nature of financial liability as well. It's got the nature of equity as well. All right. And these are called as compound financial instruments, which I will discuss in length at a later point in time when we are actually discussing about the accounting and measurement of compound financial instrument. Similarly, convertible debentures. Earlier, I was just taking the example of normal debentures issued. I, as a company, have issued normal debentures. They are a financial liability for me because I've got an obligation to deliver cash. But what about convertible debentures? If you think of it, I have an obligation to pay interest, but on the maturity date, I do not have an obligation to repay the principal because they will be converted into equity shares. I will issue equity instruments. All right. So again, this is a case where a portion is having a financial liability characteristic and a portion is having a equity characteristic, and therefore it is again a compound financial instrument. The recognition and accounting, we'll treat it, we'll look at it at a later point in time. All right, that's it for this lecture. We'll meet in the next lecture where I will actually discuss about classification and measurement of financial assets.